Most traders keep losing money. They don't even know why. They think it is a bad luck. They think the market is against them. And sometimes they think they need a new strategy. And that is wrong. You don't need a new strategy. The market is not against them. Just that there are three things you are missing out. There are three secrets that can help you become profitable. If you have been struggling to stay consistently, then this could be the missing part. Looking at this chart example, you can see the market is on trend while the market is in correct downtrend. You can see that the market is in downtrend while the market is in correct uptrend. This could be the reason why you will buy and the market will start selling. You will sell and the market will start buying. This is because you fail to understand the bigger pictures. You fail to understand the market structure. You fail to understand what the bigger guys are doing. And in this video, we are going to break everything down and tell you the three secrets that can help you become profitable. So stick with us, because by the end of this video, you'll be able to know how to trade smarter, win more, and avoid the mistakes that keep most traders stuck. Before we jump in, make sure you click that subscribe button, turn on the notification bell, and like this video so you can get notified whenever a new video like this drops. And if you want to become a profitable trader, then consider joining our community using the link in the description of this video, because there we share more trading guides, more trading tips, and we share the knowledge we have about trading that can help you become profitable. Now, without further ado, let's jump in. Number one is top-down analysis. This is the secret that most traders ignore. Most traders jump straight into trade without looking at the bigger pictures. That is a huge mistake. Imagine trying to drive a car without the keys. The bigger pictures are like the keys that drives the price. You begin with higher time frame, then go down to the lower time frame for entry. Depending on the trader type you are, you can choose to combine three time frames, like the weekly time frame, daily time frame, and 4 hours time frame. Daily time frame, 4 hours time frame, and 1 hour or 15 minutes time frame. So this is where you have to ask yourself a question: which trader type I am? Because a swing trader, a day trader, and a scalper don't use the same time frame. If you're a scalper, then consider using 1 hour, 15 minutes, and 5 minutes. If you're a day trader, consider using 1 day time frame, 4 hours time frame, and 1 hour or 15 minutes time frame. Then if you're a swing trader, consider using weekly time frame, daily time frame, and 4 hours time frame. Just combine three time frames that are not nearly the same. This can help you to identify the order flow of the market. It can help you to know what the bigger guys are doing, and it can help you to identify key levels, stronger key levels that can push the price up or down. And the problem is some people use 1 hour and 2 hours time frame, which is totally wrong. You can use 1 hour and 2 hours time frame because they are nearly the same. They can give you nearly the same result. You can use 4 hours and 3 hours time frame because they are nearly the same. They can give you nearly the same result. Just combine any three time frame that are not nearly the same. You can still combine 4 hours time frame, daily time frame, and 5 minutes time frame. Right? So depending on the trader type you are, you can choose to combine any time frame for your analysis. The main purpose of doing top-down analysis is to know what the bigger institutions are doing. If you find a pair that is constantly going up in a higher time frame, like daily time frame, that means the bigger institutions like the World Bank, huge market participants are constantly buying. Then what you can do is to go down to lower time frame to find entries. If you find a market that is constantly going down, that means big institutions are selling. Then you can go back to the lower time frame to look for selling opportunity. If you find a market that is constantly rejecting a support and a resistance level, that means bouncing off a support level and bouncing off a resistance level. This could mean that the market is ranging. Then you go down to the lower time frame to find a correct entry. At this point, we are going to do top-down analysis on Xauusd and USD JPY so that you can understand why you need top-down analysis. Now, let's go. Now, we are going to see why you need top-down analysis and how it can help you to become a profitable trader. First, understand that in uptrend, the market will start creating higher high, and higher high. Okay, but in downtrend, the market will start creating lower low, and lower low. In consolidating market, the market will keep bouncing off a resistance levels and a support levels. Okay, now you understand this. Now looking at this chart now, you can see that this is uptrend, but that is because you did not check another time frame. If you come up to the higher time frame, you see that market is what? Trending down. Meanwhile, you have already decided that the market is trending up. That's why I'm going to look for buying opportunity. Now we come to this higher time frame and we have seen that the market is what? Trending down. That means big institutions are selling. Now you have to look for what? Selling opportunity. If you didn't come up to this higher time frame, if you used only one time frame, you could have ended up saying that the market is what? Uptrend, and you messed everything up and you keep losing money for that. Okay, so now if you come out another time frame, like 4 hours time frame, now you see that the market have been in uptrend. Markets have been in uptrend, now started a new downtrend. This can give you opportunity to enter now and make insane profit. As you can see, this is a new downtrend that the markets have started. That means the market is no more trending up, the markets have started trending down. This can help you to avoid unnecessary mistakes while trading. And also on this 4 hours time frame, as you can see, this is a key level. And also when the price came to this key level, as you can see, the market started buying immediately. So if you did not come up to this higher time frame, you will be unable to find out this strong key level. So you could have made a lot of mistake and a lot of loss. Now this is USD JPY. This is 4 hours time frame. Looking at the chart, you can see the market is creating series of lows, and you can end up seeing that the market is trending down. Yes, the market is trending down, but there is something you are missing because you used only one time frame. You want to enter the market using only one time frame. You did not check another time frame, you did not check the higher time frame. Okay, so now going to 1 day time frame, as you can see on this 1 day time frame, market was trending down, but at this point now the market is sitting at a strong key level. If you keep selling this, you may make a lot of losses. Okay, seeing that the market is now in dangerous zone, this is a time to pause trading and know if the market will start buying. If the market will start buying, then you enter immediately and your target will be here, because this is a new uptrend that is created because of what? Because of this strong key level that the markets have jammed. So using this top-down analysis, you have seen that this is a strong key level and it may stop this downtrend, causing it to start buying. And as you can see, market is already preparing for a great push up. So now if you do not do this top-down analysis, you will keep thinking that the market is selling and you start looking for selling opportunity, and you will end up making loss everywhere. Now you see the reason why you need top-down analysis. Now I ask you a question. Do you think you can do without top-down analysis? Drop your answer in the comment box. Now the second secret that separates the winners from the losers is F and R levels. Successful traders focus on recently levels and frequently levels. These are the levels that matters most. And mind you, this is applicable to volatile pairs like USD JPY, Gold USD, US30, BTC USD, and other volatile pairs. You have to understand that the market moves based on the levels that the price reacted most. That means if price break a level, the next level is the next target. If the price rejects a level, then it may come down to the previous level. That means the price moves from level to level. This is applicable in volatile pairs, so I don't know for other pairs. Volatile pairs like Gold USD, BTC USD, USD JPY, it works perfectly for them. Then you have to ask yourself a question: which levels are most important? Think of it like this: if the market keeps bouncing off a level, the traders will start looking at that level. Meanwhile, the market can create another level, react to it, and what? Move on. Why they have missed a trade? If you add this concept to your strategy, you won't miss a trade, because frequently created levels can be a new support level, they can be a new resistance level that can push the price to keep going in its trend. Now I'm going to open XAUD to show you a chart example on how to use these F and R levels to make insane profits and come out profitable every time. Now let's go. Now focusing on recently and frequently levels, that are the F and R levels. Let's see how it can help you in your trading strategy. Just assuming that a price is bouncing off from a level, went again, came down and bounced off from this level, went again, came down and bounced off from this level. Then on the process of going up, it may create another level here at this point, then went up, coming down. Some people will stay expected to come and bounce off from this level. Meanwhile, it have created another recently level at this point. As you can see, this level have head here, so it is a frequent level, and also it is recent. It's happened recently. So instead of waiting for the price to come here, you can look for some entry opportunity here. That doesn't mean the price may not break here. It means that this level is now stronger than this level. Okay, so the price may stop anywhere here. before bouncing off. So some people waiting for the price to come back here will miss the trade. So this is Xauusd, and we are going to see how F and R levels can help you in your trading. Okay, so just imagine the price drop from here. It's dropped from here. Now make it high and make a low, make another high, and broke this low, meaning this is now a level. Okay, so when it came down to this point, some people will keep waiting for it to come back to this level because they may assume that now this will be a resistance level or a key level or other block, whatever you call it. Okay, still waiting for the price to come here. The price created another level here before dropping. You know why? They are still waiting. You understand? So now the price coming up, they will say, okay, the price is now coming up here without paying attention to this recent level. As you can see, the price just touched the recent level and dropped massively. They have already missed the trade, and you didn't miss the trade because you know that recent levels are stronger levels. Okay, so now as you can see, if you jumped in here because of this recent level, you could have made insane profits. And the third secret that can help you become a profitable trader is increase your capital, not your risk. Most traders want to increase their profits. They will increase their risk per trade. Instead of increasing your risk per trade, increase your capital. Take for instance Mr. A and Mr. B. If Mr. A have $1,000 trading fund and Mr. B have $100,000 trading fund, Mr. A can say, let me risk 50% of my account, that is $500. He will lose all his money within 2 or more trades. But Mr. B, having $100,000, he can decide to risk 1% or 0.5% of the account. That is $500 or $1,000. He will come out profitable every time. So instead of increasing your risk, increase your capital. This can help you to reduce your risk and increase the profits you make. But the question now is, how can I get $10,000, $50,000, $100,000 trading fund if I don't have money? Now, this is where prop firm comes in. There are prop firms that are willing to give you $100,000, $500,000, $50,000, $10,000 trading fund. But first, you have to prove to them that you can trade. You can get $10,000 fund for as low as $30. You can get $50,000 trading fund for as low as $50. A prop firm like Marvin's is the cheapest prop firm I know for now. They offer you $5,000 prop firm accounts for as low as $15, $20, sometimes $22. Prop firms like Willis Capital can offer you $10,000 trading fund for as low as $60. That means with small fund, you can increase your capital. So for you to start trading with big capital, you have to deal with prop firms. I recommend Marvin and Willis Capital. Check the link in the description of this video, click any of the link and sign up with your email address or password. Now purchase any prop firm account you want and start trading with the bigger guys. Using these 3 things, the top-down analysis, focusing on recently levels and increasing your capital instead of your risk, can help you become a profitable trader. They are the secrets that losers don't know. So you can see now that these 3 things can help you become a profitable. Drop your opinion in the comment box and don't forget to join our community using the link in the description of this video. We drop more trading guides, more trading tips that can help you become profitable. Don't forget to smash the subscribe button for more videos like this. For now, goodbye, good luck.